Hello everyone. So before I start this video, let me ask you this very important question. Have you ever wondered how large institutional players such as HDFC, ICICI, Kotak Mahindra Bank or brokers such as Motilal Oswal or Sher Khan and their analysts make a recommendation about a particular company, whether to buy or sell it? And what kind of process they follow while recommending those decision. Now if you are interested in those kind of questions, yes, you have landed at the right place, and I, Margesh Patel, will explain you in the next 10 to 15 minutes those processes. So before spending any more time, let's dwell right into it. Now let's understand first basic aspect of ratio and its analysis. Let's take an example of Reliance. Now Reliance company. Now if we want to analyze Reliance, we can do it in two ways. The first one would be time series analysis, and the second one would be cross-sectional analysis. Now, as the name suggests, what would be a time series analysis is? Now let's suppose that if we analyze Reliance over 2005 to 2018, this kind of analysis of a single company over various years is known as time series analysis. So if you are comparing company's profit, Reliance's profit from 2005 to 2018, that would be considered as time series analysis. On the other hand, if we compare two competing companies like Reliance and Adani for a single year, let's suppose that is 2018, then that would be considered as cross-sectional analysis. For example, if we compare Reliance profit and Adani profit for 2018, that would be considered as cross-sectional analysis. So this two analysis is basic understanding of how ratios are analyzed. In the next slide, we will go through how ratios came into being and what are the basic ratio we should look at while analyzing a company. Now, first one here is liquidity ratio. Now, liquidity ratio is a ratio which look at the short-term obligation. On the other hand, we have solvency ratio which look at long-term obligation. Now we have profitability ratio which consists of EBIT, then EBITDA, then comes gross profit, then comes net profit. In activity turnover efficiency ratio, we look at companies operating efficiency and corresponding scenario. So now company operate with mainly three stakeholders. One is supplier, one is customer, and one is internal process, which mainly carries in terms of inventory. Okay. And last but not the least, we will look at the stockholder related. So if you look at the financial analysis company such as Money Control, so you will go through ratios such as earnings per share, price per earnings, which suggest how a company is doing with another set of company and its valuation. So this was basic understanding of how 5 ratios are computed and what are their significance. Now keep one thing in mind here is that these ratios are not governed by any governing body such as SEC of United States or SEBI of India. These ratios are made for the significance of large institutional player to analyze and give a recommendation for a particular company. Now in next slides we'll go through each ratios one by one. Now in liquidity ratio we compute three major ratio. First one is current ratio, second is quick ratio, and third one is a cash ratio. In all three, denominator consists of liabilities, and in top it mainly consists of current assets, and from current ratio to quick ratio to cash ratio we deduce some kind of assets to finally come at only cash and marketable securities in cash ratio. Now why we compute this liquidity ratio as explained earlier? To measure its short-term obligation. So let's take an example to understand how this can be useful, how short-term obligations can be fulfilled. So let's carry out an example of Reliance, and today is the date of, let's suppose, December 1st. Tomorrow is December 2nd, and tomorrow company has to pay 100 crores to its suppliers. Let's suppose last year company's PAT was, profit after tax was 1000 crore. Now on the other hand, company has only 50 crore in cash in hand. Now let me ask you whether this Reliance will be able to pay its supplier or not. Whether it will be able to pay its supplier or not. The answer is it will not be able to pay its suppliers. The reason being it has only 50 crore of cash in hand. We can't look at this figure of PAT of 1000 crore because the company might be investing those 1000 crore in some other assets such as land or equipment or any kind of plant. So if we were to look at a short-term obligation such as paying supplier on December 2nd, we have to look at cash in hand, or as a matter of fact what kind of current asset a company has in its balance sheet. So this helps in understanding its short-term obligation fulfilling. Now this slide mainly deals with the operating efficiency of a company. Now almost all company has three stakeholders. The first one being suppliers, the second one being its internal inventories, and the third one being customers. Now we will see how all these three stakeholders are related to its financial statements. So suppliers are linked through accounts payable. Now let's consider an example of Reliance. Reliance is transporting its all shipments, and while paying those contractors, whether it uses a cash instantly or they are paying their suppliers on credit. So these things are related through accounts payable turnover ratio, which suggests that credit purchases divided by account payables, and the average payment period is computed by 365 divided by average payable turnover ratio. Now these two ratios are related with the supplier side. Now we will go through the inventory side. Now company, how much time it uses that inventory, or how much inventory at a given period of time company is having on hand, this can be computed through inventory. So there are two ratios to measure that: inventory turnover ratio and cost of goods sold. inventory turnover ratio, which is COGS divided by average inventory, and there is one more ratio which is inventory holding period, which is computed by 365 divided by inventory turnover ratio. Now the third stakeholder, customer, how they pay. For example, Reliance sells its oil to a company in Africa. Now that company pays back Reliance whether in cash instantly or on credit cycle. Now this is interrelated with the supplier. Again, in this case, Reliance will be a supplier for another company which is based in Africa, which might be buying it from Reliance. So it's all interconnected, but at the same time it is very simplified. Now this customers, and this can be attached to a financial statement by accounts receivable, is computed over here. Accounts receivable turnover ratio, which is credit sale divided by average accounts receivable, and average collection period can be computed by 365 divided by average receivable turnover ratio. So this two ratio will cover customers perspective, this created inventory perspective, and this created suppliers perspective. There is one more perspective which can be looked at from shareholders perspective, which is asset turnover ratio, which computes sales divided by average total asset. So this is a operating portion and how efficient a company is operating. Now profitability ratio. This is very important and widely used ratios in the world of finance. We often hear every quarter that this company made this net profit and it surpassed the expectation of analyst, or it did not surpass the expectation of analyst. So what is profitability and how we can compute those ratios? So before dwelling into those subjects, let's first look at the basic understanding of income statement, which will be covered in later videos as such. But for the sake of profitability, let's go through it one time. So let's start with revenue and sales. If we deduct cost of goods sold, we will get gross profit. If we further deduct selling and goods administration, we will get operating profit, which is also known as EBITDA, which is earning before interest and tax and depreciation and amortization. If we deduct depreciation and amortization, we will get EBIT, which is earning before interest and tax. If we deduct interest charges, we will get profit before tax, PBT. If we deduct tax charges, we will get profit after tax, which is also known as net profit. Now, if you look over here, gross profit margin would be gross profit divided by revenue and sales. Operating profit margin is operating margin divided by revenue and sales. Net profit margin is net profit divided by revenue and sales. Return on investment would be operating profit divided by average total assets. Return on equity would be profit after tax, which is this, divided by owner's equity, which shows that how much profit a company is earning on given owner's equity. And last but not least is earning per share, which is profit after tax divided by number of outstanding shares. Now why we compute profitability ratio? The reason might, let's take an example. Let's suppose Reliance last year made a profit of 1000 crore. Let's take 500 crores, right? Reliance and its competitor Adani made a profit of 100 crores. Now let me ask you this question, whether Reliance is better performing than Adani or not? So the answer should be we cannot say. Why? Because we have to compare it with its total revenue. For example, let's suppose Reliance made 500 crore profit on 10,000 crore sales, which means its gross net profit margin is 5%. On the other hand, Adani made 100 crore profit in 1000 crores of revenue, which means Adani's net profit margin is 10%. So this way we can compare these two ratios and finally come up with the recommendation that Adani has outperformed Reliance in net profit margin. This is the main reason why we look at the profitability ratio to compare two companies. Now in solvency and leverage ratio, we look at the long term obligation and we look at three major ratios. Debt to asset, as the name suggests, total interest bearing debt divided by total assets, and debt to equity ratio, long term debt divided by owner's equity, and interest coverage ratio, time interest earned, which is equal to operating profit divided by interest expenses. So this three ratio cover the solvency portion, which is long term obligation portion. Now we will look at the shareholder related or market value ratio. If you look carefully at this slide, you can see many ratios on sites such as Money Control, which compares a base price of a company relative to its industry or its competitor. So various ratios are P, price and earning ratio, which is market price divided by earning per share, earning yields, which is 1 by P ratio, then comes dividend yield, which is dividend divided by market price, then comes dividend payout, which is dividend by EPS, then comes book value per share, which is owner's equity by outstanding shares, then comes market book value, which is market price divided by book value of share. These ratios are important in going for valuation of company. Valuation related ratio, very important stuff. Now we come to the end portion of this video where we analyze all four types of ratios, starting from liquidity for short term, solvency for long term, profitability for how much it is generating profit on a given equity or assets or revenue. Then final comes activity ratio, which gives you an overlook of how efficiently a company is operating. If all these ratios are combined to compute a certain ratio, that kind of analysis is known as Dupont analysis. And the reason why it is known as such is it was given by a salesperson of a company called Dupont Explosive in 1912 for the computing of internal efficiency, and from there it becomes so popular that even today we use Dupont analysis to compute company's internal strength. So major used ratio is return on equity. So return on equity can be written as net income divided by owner's equity. Now here, if we multiply by net sales and divide by net sales, the equation will remain same. Further, if we multiply with total assets, and again divided by total assets, again the equation will remain the same. Now, why we are doing this is to differentiate return on equity, which is one ratio, into three different ratio, which will be financial leverage, asset turnover, and profit margin. What is profit margin? Profit margin is net income, divided by net sales. So we will remove net sales from here and net income from here. What is asset turnover? Asset turnover is an activity ratio. Profit margin was profitability ratio. Asset turnover is activity ratio, which is net sales divided by total assets. So we will remove total assets from here and net sales from here. The final, last but not the least, is financial leverage. Financial leverage can be written as total assets divided by owner's equity. So we will remove both of them from here and we will end up with a single ratio divided into three separate ratios. This is what known as Dupont analysis. Why we are doing this? Because assets can be traced down to current assets, which is basically liquidity ratio, help in understanding liquidity ratio, and operating, which can be from profitability ratio. And asset turnover it's itself an activity ratio. So this is how a Dupont analysis can be useful in analyzing a particular company. So in conclusion, we have covered three basic aspects. First one being how to analyze a company, whether to go for time series or cross-sectional analysis. Second, if you want to do an analysis, what kind of ratios should you look at? So second one is ratio, and third one would be how those ratios are helpful in determining a particular recommendation, whether to buy or sell a company. So this three aspects we have learned so far. Keep watching this channel to learn more about finance. Till then, please like, comment and subscribe to this channel. Thank you.